All right, Alpha Index fam, let's get real. You've seen the headlines, heard the panic in the news, and maybe you've even checked your portfolio and seen a sea of red. That feeling in your stomach? That's what we call fear. And when it comes to investing, fear is your biggest enemy. It's what drives people to do the one thing they should never do: sell everything in a panic. But what if I told you that a stock market crash isn't just a sign of trouble, but a test of your principles? It's not just an event, it's a lesson. And by the end of this video, you won't just have a plan, you'll have a new perspective. So, let's dive in. The first principle we have to understand is this: the market is a psychological arena, and the game is won by those who think long-term. Think about it. When the market is booming, everyone feels like a genius. The headlines are full of success stories, and the fear of missing out, or FOMO, is at an all-time high. But when the market turns, the crowd's mindset shifts. Optimism turns into pessimism, and FOMO is replaced by fear. You see, the majority of people are reacting to the present moment, driven by emotion. They are short-term thinkers in a long-term game. The smart money, the hidden wisdom, is knowing that these downturns are not a sign of the end. They are a natural and necessary part of the economic cycle. The second principle is that volatility is not risk. Volatility is simply the measure of how much a price moves up or down. A stock that swings wildly is volatile. True risk is the permanent loss of capital. Selling your assets at a loss because of a temporary dip is what creates that permanent loss. A crash doesn't just destroy value, it reallocates it. It's a transfer of wealth from the impatient to the patient, from the emotional to the logical. Those who understand this see a downturn not as a punishment, but as an opportunity to acquire high-quality assets at a discount. So, how do we apply these principles? It starts with a game plan. First, you need to understand your own financial situation. Don't go all in on a whim. The first step is to have a strong financial foundation. That means an emergency fund to cover at least 6 months of living expenses. This isn't just a safety net. It's a mental barrier that prevents you from having to sell your investments to cover an unexpected expense. Second, a crash is not the time to stop investing. It's the time to double down on your long-term strategy. This is where dollar-cost averaging becomes your superpower. By consistently investing a set amount of money at regular intervals, you buy more shares when prices are low and fewer shares when prices are high. Over time, this lowers your average cost per share and helps you take advantage of the market's volatility without trying to time it. Third, focus on quality. A market crash will sweep up both good and bad companies, but a high-quality company with a strong balance sheet and solid fundamentals is much more likely to weather the storm and emerge stronger on the other side. This is the time to do your homework and identify those businesses you believe will thrive over the next 10, 15, or 20 years. Finally, and this is the most important part, you must master your own mind. You have to be an observer, not a participant in the market's fear. When the news is screaming and everyone is panicking, you need to stay grounded in your principles. Remember, the market has recovered from every single crash in its history. This isn't a guarantee of future performance, but it is a powerful reminder of the resilience of the human economy. A stock market crash is not a reason to panic. It's an invitation to think differently. It's an opportunity to apply principles that most people ignore. So the next time you see a sea of red, don't feel fear, feel clarity. Understand that this is a moment for disciplined action, not emotional reaction. This is when the long-term investors are truly separated from the short-term speculators. Stay true to your principles, stay focused on quality, and trust in the long-term growth of great businesses.